When the Federal Reserve began tapering its bond buying late last year, I mean by this much, interest rates did the complete opposite of what a lot of people anticipated they would do. Everyone thought they'd go up. They actually continued to move lower. Our next guest says this trend is not really surprising. He believes bond bear sentiment will slowly unwind and more bulls will emerge. What trends is he seeing and where can you find dividend yields as rates fall? Joining us now, J.C. Parets. He's Eagle Bay Capital founder and president. That's what was most surprising. Everybody thought rates would start to tick higher, but in essence, they weren't raising rates. They were simply scaling back or tapering on massive bond buying. Why do you think rates behave that way?
It's actually fascinating to me, and you talk about how everybody was expecting interest rates to rise, and that was common knowledge, and you could see it from all the sentiment polls. The pessimism in the bond market were at levels that we hadn't seen since the beginning of 2011. And what happened there? Treasury bonds went up 50%, and interest rates went from 3.7% all the way down to 1.4%. We haven't seen pessimism like that until December. And what's happened ever since then? Rates have been coming down, and bonds have been ripping.
Now, Janet Yellen spoke today. Boy, did she strike a very accommodative and dovish tone, saying the economy's not very good. It still needs our help. So does that mean that rates will continue to go lower from where you stand?
It's interesting because she says one thing, and then people interpret it one way, and then she says something else, and people interpret. So we don't worry about what people are saying or what they're doing, and at the end of the day, you know, Janet Yellen is looking at backward-looking information. The economy, these are lagging indicators. The market, by definition, is forward-looking, and the market has, they've been buying bonds all year. The stock market is flat year-to-date. Bonds are up 7-8%, depending on what you're looking at, and I think that continues.
Okay, so, J.C., your value is that you look at what the herd is doing and find mistakes and cracks in what the herd is doing. Right now, the herd's piling into bonds. I mean, bonds are up 8% year-to-date, while the stock market in general is pretty much flat.
That's exactly right. So, and the herd is generally right. So what we like to focus on is when these herd mentalities are at extremes. And like I said, at the end of last year, there were levels that we hadn't seen in years. So that unwind has already begun. And typically, when they're coming off extremes like that, those new trends tend to last longer than most people expect. So I'd be surprised if bonds didn't keep ripping from here.
Tell me what you are advising people to do.
Yeah.
You said bonds will keep ripping. You say get into bonds. Which part of the yield curve?
Yeah, well, we like the TLTs, which is the bond, the ETF. The TLT specifically is probably the most liquid way to take advantage of that in the equities market.
Okay.
Right now, we're looking at about 115, 116 as a target. That's a big Fibonacci retracement from last year's decline, and it's also former support from the beginning of last year. So where there was demand, there should be supply. I'd be fading it at that point and then reevaluating the situation.
Just as everyone thinks they know where rates or where the stock market will go, they don't. They have obviously made mistakes, or at least the market's in a way, voting machine just moved in a different direction.
That's exactly right.
How low do you expect rates to go before they finally turn up?
And that's a great question. Now remember, let's put things into perspective. I mean, rates have been coming down for over 30 years. This is nothing new. So when I hear people talking about a rising rate environment or whatnot, that's clearly not the case. We're still making new lows. This is still a downtrend, and this takes time. This is a process. When rates bottomed out in the 40s and 50s, this was a 20-year process. So I wouldn't be surprised if they stayed flat.
See, money in treasuries was dead money over the past year, minimum.
Yep.
It was like keeping, there was no yield. It was like keeping money under a mattress. Yet you're saying go into it.
So two things. I've been saying it all year that bonds are going up. I still think they do. I think rates see about 2.45%, maybe hover on there for a little while, and then we'll probably see about 2.1%. Looks like the ultimate target. And you're seeing the stock market tell us the exact same thing. You have fixed income traders that can't get their yield in bonds, so where are they getting it? They're getting it in the stock market. Where? Utilities and REITs. The stock market is flat this year. Utilities are up 10%. REITs are up 8-9%.
J.C. Parets, great to have you. Thank you so much for joining us. David,